set to go. Had a reasonably, I don't want to say choppy, but just relatively low volatility trading session today. We actually can see here, so what this workspace is set up for here. I've got the ATR down below, and the way this is set up, and if you're interested, you can set it up this way. Just throw on the average true range onto a daily chart for the products that you trade. And this is really more relevant to intraday trading, but if you apply the same sort of logic to, sort of longer time horizon, effectively what we're looking for is volatility. And an easy way for us to measure it for various products, probably even better than or more relevant to us than, just looking at the VIX, although, a lot of times it'll tell us kind of the same picture here for the S&P. But we're looking for volatility. We're looking for price action that's going to give us opportunities to trade. That's going to give, or that's going to make the market more forgiving when prices are being discovered, and we're going along with the price and looking for a market direction. If it's starting to trade higher, effectively what we're looking to do is we're looking to find a good entry point. We're trying to find a good low-risk entry point where we've got the probabilities in our favor, market's shown us by price discovery that it's going in a particular direction. And if we're able to recognize that early, we may have an opportunity to profit from the continuation of that move. And of course, what we're doing is managing risk. But all of that really comes down to, or the success of that really has to do with whether the prices are moving at all. So this number here gives us a good idea of where that is. That's the blue line over here. Today that's reading like just below 15. So on average about 60 ticks of price action. All right. Over here I've got another one set up. This is another ATR, and it's just drawing the one. Right. So that one bar. So the blue line there is just normally what you'd see is just an average. And then today we had 16, so just actually a little bit better than 60 ticks of price action. Now for us, typically what we like to see for trading is really, as our sort of rule of thumb, is 80 ticks of price action. So lately, a lot of the markets don't really fit that, and while that doesn't make it so that we can't be involved, it certainly makes things less forgiving. And the idea there, if you think back to slow periods where market price action is very limited, is a really good example of that. If you traded back in 2013 or 14, when the price action was very limited, and markets would open up, it'd be flat all day. So even though the market was up a lot over that course of that year, all the price action, or most of the price action you'd find was either very gradual or it'd be overnight, where you'd open up on a gap and prices would trade in a 5-point range. And if you're a trader in that price action, any amount of risk that you could lay out, even any sort of reasonable amount of risk. I mean, if we're talking risking as little as a point, that would be a quarter of the price action. Or a quarter of the range. Real quick, this is what it looked like if we could have, basically just using the same best practices that we talked about in all the other charts, if we could have avoided losses, that would have been really the best that we could hope for, since the range was, even the Russell was 5 points. So support bouncing off, looking for a move higher, didn't come. Breaks to the downside in a sharp fashion, and is outside the bands. The pullback, it's sort of against the major trend direction, looking for the uptrend to continue, takes out the highs, right? So it takes out the intraday high, pulls back, and then finds what is going to be the intraday high of the day, and then turns around. But at that point in time, we'd be looking at about 4 points open profit, so about $200 per contract. And if we didn't see that as a reason to take some profit off the table, well, then we would really have to have gotten a scratch. But if we took a little bit off, the net exit would have been just slightly higher. The red bar here, going against the major trend direction, we see a sharp move down, right? So, parabolic move down, and then the pullback, and then coming into the remaining part of the day. If we looked at this, we have a sell signal set up. If I draw a line here from potential entry points as prices are testing resistance here, right, we would have seen potentially a little bit of open profit again, about 5 points to the downside, and then here, if we didn't take it off, it would have been a scratch again. Here we see a no trade zone, but again, I used to kind of like to say this. I mean, I don't think a lot of people like to look at it this way, but if we have an entry here and we can see the risk is down here, and we have a roadblock here, price are able to continue up into this point, and so really, right there, it's about even when it first comes in. If we're able to see it down here, right? If we're able to see an entry down there, well, then the risk and reward is more favorable. And prices, get into the resistance, pull back. You can see here's, the setup afterward. So afterward, right? So if we looked at, instead of an entry down in here, we got a second chance and took it into the close. That was actually not a bad trade. That was about $300 per contract. All right. Anyways, take care, everybody. Have a great rest of your day, and we'll talk to you later.